Ladies and gentlemen, welcome back to FinStep Asia Token Bytes. We are here, day three of Leap, and we are going to be speaking to more industry leaders, in particular, talking around the space of insurance, insurtech, and the changes we're seeing across Asia. Truly honored to have Shwetank, who is the co founder of Leo Capital, also the co founder of India Insurance Association. We've known each other for a while, and it's good to finally see you here in Hong Kong.
Thanks for having me, Syed. It's good to be here.
How's your 2 days been? What's your impression of Leap?
Yeah, I mean, as always, these things are hectic.
Yes. Yeah.
But I think for somebody who's spends a lot of time in Southeast Asia and South Asia, seeing East Asia's innovations and Chinese startups, it's very helpful. So
Yeah.
it's been an eye-opening trip. Hectic, but
So, I mean, we'll take a little step back and we will talk about the industry and we'll talk about insurtech broadly speaking. But I would love to hear your journey into getting into the investment world. How did your journey go through in terms of getting into the investment world, but also the story of Leo Capital?
yeah, absolutely. So, look, I've always been an entrepreneur.
Yeah.
Started sort of doing small businesses at the age of 14.
Wow.
Built my first business at the age of 18 in university.
Nice.
Had a lot of fun doing that. And I always assumed that I'm going to be building businesses.
Sure.
I made a move from Singapore to India in 2011, and then tried to build a startup in India. I learned the hard way just how hard that is.
Yes.
So managed to sell it, and then I was sort of figuring out whether I want to do another startup or do I want to sort of build a career, etc. And realized that I don't have the requisite focus left to do one startup. But I definitely wanted to work with founders. And I found that really I was quite unemployable. So the only thing left was to start an investment
You're
career.
being very modest in terms of saying non-unemployable. So many founders struggle to get an exit, and you got an exit as hard. Even harder, I think, is building a startup is probably relatively a walk in the park to getting an exit.
I mean, exits, a lot of exit is a matter of luck as well. So we got lucky, but happy to have an exit. So after considering various options, I decided that the best way to work with founders was to build a fund which had more of an operator lens.
Sure.
So the core focus at Leo initially was to find people who have built businesses. So if you look at our founding team, you look at our whole team, you'll find that counted the other day, there's 16 companies that have been built and over 15 billion in value.
Okay.
Exit value from Leo team.
So unicorn status for each.
On average, a unicorn.
On average, yeah.
And it's beautifully indicative of the power law because one of those companies is 10 billion.
It looks nice on the deck.
Exactly. So it's a VC portfolio within the team.
Yeah.
And that's we sort of said, hey, when we started in 2018, that pure operator turn VCs in India were not that common. And the other thing I wanted to do was solve for people like myself.
Sure.
Who are 50% out and 50% in. So we spend large parts of their life outside. So about third culture kids or sort of first generation immigrant entrepreneurs.
Yeah.
So that's what we've been doing. So bring in the operator know-how and support and focus on the Indian diaspora. And see how we can support them with the fantastic possibilities.
It's an interesting approach as well, and we've seen in Silicon Valley how a significant number of the big tech firms and general tech firms have an Indian born founder. So they're probably all executives are largely there. So, and it's the perspective of doing that in Asia also, you do see that, especially in fintech and broadly as a overarching industry focus, you see quite a few in this space.
Yeah, I mean, so we've been out there looking for innovative founders. They're everywhere.
Yeah.
From Iceland to Greece to the slightly more common things like Australia, UK. So we focus more on Europe. Because I think, so India, US, of course, is very well catered for.
Right.
It's not a venture friendly. They do it as well. India Southeast Asia and India East Asia is, I think, very early. Still early. We started seeing, I think, the first generation of such founders, especially in Japan, where there's been a massive move.
Yes.
But still not enough density to really do full fun. And then, of course, just to see India, Europe remain two massive opportunities.
Yeah. And so, how's been that journey? Like, it's been nearly 15 years since Neo Capital.
No. Neo Capital started
2018. So, 8 years. The loop, and the lucky number 8 in many instances. What for you has been, the journey has been 2018, 2 years later, COVID. There's also very seminal point when it came to fintech and insurtech investments as well. We had a whole digital transformation that happened. And so, how did you see that move? Those early days, and when you were picking companies, what were you looking at beyond the fact that the knowledge and founders were like that?
Yeah. So it's been a very tumultuous 8 years. We had COVID, the Ukraine war, a bunch of things. It's great to have survived. We've raised 4 funds, $1 billion of AUM. So I think we laid the foundations for building a generational fund. The COVID times are crazy. The price of money was zero. So it was zero interest rate environment. A lot of spending and a lot of investment got pulled forward. So in hindsight, it was a little too frenzied. So you had companies raising astronomical rounds. Barely, we had companies with $1 million in revenue with $100 million valuation. So that hangover is taking a while. It's clearing out. I'd say that the more exciting wave is really the current AI wave, which is truly transforming how work is done. So COVID moved a bunch of things that were easy to digitalize into digitalization, but now we're seeing the human element itself get soft, so from software as a service to service as a software.
Sure.
That's a big trend. That's going to be a defining trend over the next decade. Of course, lots of open questions. What happens when token costs go increase? How do you think about the open source models in China? Tons and tons of unanswered questions. But the speed at which companies are reaching, sort of, say, 5 million in revenue is just incredible. And how few people it's taken. So earlier you'd take 50 people to get to 5 million. Now you take 10. So that's a big change.
And that whole conversation on the one-person company, right? And stretch, but
yeah, I think one-person company is very lonely, man. I don't know. Not recommend it.
You have the agents for company.
It's
one person and agent company.
I'm not on board with that, but definitely productivity per employee, revenue per employee, all these metrics have transformed in the last 2-3 years.
I would also say, I know you're quite focused on the insurtech space. How did that come about in terms of why you narrowed down on insurtech? I know there may be a few more adjacent fintech investments, but what was the driver beyond that?
Neo Capital, we are a generalist seed fund. So we invest across sectors. My personal passion is insurtech. I built my company in India was an insurtech company, and it's a huge underserved industry. People don't realize how much insurance touches every aspect of your life, from your home to your health to your afterlife.
Of course,
it is literally present across every field of human endeavor. So it's been one of those areas that I got more and more interested in, and obviously, yes, my background is a insurtech founder. We met a bunch of founders, happy to invest, and then decided to start the India InsurTech Association, which is a COVID sort of starting point, because sitting around too much time on my hand to be able to support the companies more than we can just support as an investment fund. So I started in 2020. So we're coming up to 6 years anniversary. It's in August this year.
Nice.
And we're at almost 450 members.
Amazing.
I
mean, building associations with the community is underrated. Sometimes people feel it's about building profile for people, but it's actually, you do need a community, and there is a the policymakers, the government, but even the small startups need a voice, and you need the coordination element. And having built the FinTech Association here, I totally appreciate what you're doing.
Yeah, it's not fun at all. It's tough work.
It takes up so much time. People are so demanding, right? It feels like everybody feels, oh yeah, you're an association, you got to do everything for them, right? Members and non-members. But that's the part of building communities where you want to grow that. I want to just take a step back and come back to the conversation around your capital. So next, most I wanted, you mentioned about how you had these companies with a million in revenue and 100 million valuation going on. And then, so just for an audience to understand, who would you then be picking with such a crowd, a space where it's highly inflated valuation, but you also see other funds, etc., coming in because of FOMO. I remember seeing, multi-billion dollar deals where firm was valued at maybe after 500 million, and in 3 months they're like million and a half, and another 3 months there, and there's no change in revenue or user numbers. With the AI craze, there's a slightly different conversation because it's slightly underpinned by revenues or user uptake, but there it is just round after round and inflated. How are you picking on that stage?
Well, we're not. So we're a seed stage investor. Yeah. So I think one thing we did well was stay disciplined about our entry. So we tried to enter below 20 million valuation. We stayed true to that. I think where the challenge becomes actually as a fund, this is inside fund economics for our listeners. As a seed investor, you're supposed to prorate or invest as part of your ownership in the new round.
Correct.
And that becomes really expensive when you first and then you can't also not invest because the new investor then use that as a very negative signal.
Correct.
Right? So if you're the lead investor, you won't say focus on the business.
Yeah.
Now that business is raising, say 10 million at 100 million valuation, new investor expects you to put in your 10-12% capital. Yes. That is where the challenge becomes for us because as a small fund, it really stretched and we had to really ask ourselves, is this a good use of your capital? And if not, then you can know the founders because founders are like, hey, this man is coming in and you're giving a bad signal. So some tough lessons learned there, but those were very interesting conversations. And now with AI, we have the same problem because again, but at least there is a revenue curve as well, which gives you some comfort, although it's still early, so you don't know like how much of the revenue is retained, how much of it is this curiosity revenue. So I think the next year is going to be quite tricky.
And when you were picking companies, what would be, say, your top 3-4 criteria, founders, business models? What would be the key driver? Drivers.
Yeah, it's a good question. The two main things that matter: markets and founders. And of course, it's a recursive, continuous loop, right? So the first question we like to ask is why now? Why should this company be built now? What has changed for this company to exist today? And as it's currently conceived, can it be a venture scaling? We of course understand that founders will pivot and all of that, the best founders will pivot. But we found that the best sort of success is if your first chance at least has a shot.
Yeah.
But if your first chance itself is in too small a market something, then by the time you pivot, it's too late. It's too late. So assuming those three things work, then it becomes all about the founder and founder team. And over there, really, it's sort of the depth is on founders. Obviously, we look at a few key things. One is comfort with ambiguity. A lot of founders have spent time in corporates and structured environments where the comfort with ambiguity is gone. And that becomes a big challenge in a startup. Second is initiative. Have you shown 0 to 1 initiative anywhere else? College fairs, community, whatever. But have you taken an idea, built something around it, and shown that you can that's a big tick. And third is resilience. How do you handle no? Startup life is about getting 9 out of 10 times, and how quickly do you recover from it? And then finally, your ability to be a talent. So how have you surrounded yourself with? What kind of people are you being able to bring on board? These two sort of metrics together lead to a
It's very interesting, and I want to double click as they use the term, right? To the conversation around the talent, as you mentioned, the talent magnet. speaking to Pratyush from Flip yesterday, we spoke about how for him one of the key philosophies is the story around having one smart like you and self-motivated around it. But in the broader tech sector, and without being cliched or disparaging, we now have, especially in the recent 3 4 years, very nerdy, very tech founders who aren't really necessarily people magnet, right? But they have a space, the smarts for it. So in those instances where they may not be highly communicative, but they're very, very brilliant on the technology side, how do you approach those founders and advise them or help them with their becoming at least as a company becoming a talent?
Yeah. I mean, the question that comes is, are they self-aware enough? And are they open to bringing on somebody else to be the face of the company or manage the company?
Fair.
The question really becomes, do you want to be the CEO or do you want to be like a chief product or chief scientist, whatever it is?
Sure.
And it's a tricky conversation because a lot of these founders think that it's their company and they should be CEO, and that's right. That's not wrong. But again, I think it can work for a certain amount of scale. And it can go a lot further now because, see, earlier, if you need 50 people, you really need to figure out how to build a HR system.
Yes.
And to be a people manager. But if you can get to the same number with 5 to 8 people, 5 to 8 people you can manage. You just need So I think the decision or the trigger point for pushing for more rounded teams, etc., has gone out. So it has become, rather than a 5 million revenue decision, it's become more like a 20 million. Which changes the dynamics completely. So now I think all of us have become more tolerant of founders who are slightly less in the talent space, but then you really have to spike on the tech side. You can't just be, I'm okay here and I'm really bad here. If you're bad here, that has to be like, the spike has to be very clear.
And I want to know, maybe it's just very true, right? We underestimate the scaling process. Often here in Hong Kong, I've also experienced with really smart tech entrepreneurs, and they don't have the business acumen per se, so marketing, projecting themselves. And a lot of times, once people get into the venture cycle, the CEOs are spending time outside talking, fundraising, and it's one round finishes, and the prep for the next round starts until they get close to IPO. And what has been for you, in this 8 years journey of Leo Capital before as well, from these successful founders who raised good capital, what have been their characteristics that you find has been a good way of balancing driving a company, or have you seen them more focused on that strategic side versus internally, like delegating and
I think the best founders understand there are two types of things. There's the working on the business and working in the business. On in. And how do you split your time between on and in? And how do you make sure the inside is either being delegated enough, or you've got a trusted person, etc. The best founders build that very quickly and very deliberately. And the other thing the best founders do is sell before you build. I think that the biggest challenge I see is a lot of people building a lot, especially now. It builds so much and never had a conversation with the customer. You just decided the problem and you're solving it with your.
Sometimes a solution looking for a problem. Right?
Lots that happens. It's happening with scary frequency now because you have things like lovable and emergent where you can just. So the best founders still, and especially now, because it's become so much easier to build, they sell before they build. So the conviction and build is much higher.
And now let's talk about from your portfolio, right? If you're happy sharing some of the companies that are in there and what has been their growth journey that you've seen, or
so
your Decacon maybe to start with.
The Decacon is before Leo. It is my co-founder's company, Rancho's company. Don't have to know insights from there. But in our portfolio, I'd say some of the companies that have scaled well. I think of the one big bucket is of course built in India, then in the US. Something like customers doing really well there. Approaching revenue now. They started in 2019, so it's good progress, but now then pick up the pace again. You know, I think one thing that we've seen across the board in our portfolio is this India-US corridor works very well. Companies are really capital efficient. So typically, the companies will sort of be doing one-to-one for capital raise to revenues. While in the US, historically, again, things keep changing, but typically requires a percentage. Initially, revenue raised to revenue. So yeah, I think look, we have now 90 plus companies. We have about 10 of them are more than 50.
Very nice.
And then another sort of say 20 are in that 20 to 50 range. So that's a nice maturing portfolio.
Yeah. The Pareto principle, 80-20 as well.
Yeah. I mean, some of these companies are, some of the companies above 100 million are effectively companies that have acquired our companies.
Got it. Okay.
But otherwise, the power law holds, best companies outperform the next ones, put together.
And building on this, maybe I'm going back to the AI conversation, but it'd be very interesting to hear from you, especially companies who've been around. Using the term very loosely, pre-Gen AI era, let's just say pre-Gen AI era, to now where the one the high efficiency. How are they adjusting? Because Anthropic comes up with something, and then there are the IBMs of the world are impacted by 10-15%, or very large software companies are getting massively impacted. Whether it's a real impact or not is different, but that starts having somebody can just sit up and say, okay, decently good at coding, build some solution, and can offer it maybe at a more cheaper price as they get funded by the tokenomics. Or the established firms do.
I mean, established firms are separate, but these startups are very tough. They have to effectively rebirth themselves. Be AI first, or AI native. And it's not easy. So we've already seen some casualties in our portfolio.
Okay.
Again, this is where the quality of founders comes out clearly.
Sure.
The best founders understood quickly what's happening and made tough decisions and push their teams into uncomfortable territory by saying, okay, we need to ignore this code base, we need to ignore this revenue, we need to redo this revenue as AI first, allow this revenue to go to zero. These are tough decisions. Yeah. But again, those founders who have taken those calls are thriving, and those who haven't are battling to save a business model that's fading. So, on seats and margin compression is happening high. It's going to be tough. So I think legacy SaaS, the SaaS of business, right? Legacy SaaS has to adapt, move towards more outcome-based sales process rather than seats-based sales process, and that's not going to be easy.
It reminds me of when I was starting my career as a trader. I spent 9 years doing that, and often we will look at new markets. It will be a conversation where sometimes markets aren't changing. You're making a lot of money or consistent money in a certain trade, but you start slowly seeing things change. And the really good traders were the ones who picked that change up, started experimenting, in fact, paying to the market to learn the newer strategies, and they may not make revenue on the older stuff. And then when the transition happens, they make a lot more. Whereas when you flip that, the others who are very happy with the consistent, we're making revenue, why change this? Even if the markets seem to be moving, they were struggling. And eventually, by the time it comes to the
change.
As my previous manager and a very well-known fintech founder, Syed Musheer, introduced the book "Who Moved My Cheese" to us, and he was my trading manager. So, and that was the whole story of the mice and how always looking out for the other, and being aware rather than just looking at your existing mountain of cheese. Taking this conversation forward in terms of InsurTech, speaking and with the association as well. How are you seeing InsurTech, especially in Asia and in particular with India, evolve? Because typically insurance has been a little behind the banking services when it came to digitalization. But have we reached the mark where it is now on par or good level?
I think I would say that the AI transformation of insurance is at its start. And I think it's a huge opportunity across everything from distribution to claims to underwriting. So we are from the Leo Capital side, we are investing heavily uh, in AI first sort of services around insurance. So whether that's distribution, that's claim handling, whether that's underwriting. In fact, thinking about it like fully AI native insurance, how will that P&L look different? So I think there's a huge opportunity. Of course, there is some over capitalization. Some of these companies, people have all sorts of views on Corgi, which is the current leader. We'll have to see how that plays out. I think overall, insurance is, again, like we invest in insurance all across the world. And so I think a lot of it depends on the regulator. So I think India is a good regulator, been fairly positive on technology. So I think it's caught up quite a lot, banking. But it's interesting, it's caught up in the pre-AI, and now the AI thing is going to change it all over again. So I would expect a lot of upheaval, a lot of new company formation in the next months.
And how are you seeing? I mean, in the initial days, especially with insurance, things were moving slow. It's such a data-heavy world, right? I mean, almost everything is data, right? And because of that, there was so much data security, sensitivities, and when they went as open to working with, say, InsurTech firms, right? The likes of Discovery and others. But are we seeing that now having gone beyond inflection point after the COVID and digital transformation? Or is it still very much, okay, we will see something which is not touching data, we want to build our own tech?
I think a lot of incumbent companies want to build their own tech. My message to them always is, you're a great insurance company, you're a terrible tech company. And it sort of falls in flat. It falls in deaf ears everywhere. And this is a global. I don't know if you saw the Wall Street Journal the other day published a piece on State Farm. With this one, it's you're a great insurance company, stop trying to be a tech company. I don't think it's going to change till there's a generation change in leadership. Because insurers, and especially executives in insurers, have grown up with this mindset of safeguarding their policy holders, policy funds, and hence policy data. Now, the reality is that that's probably the right approach. Not suggesting you should make it everything open, etc. But tooling exists now to make it de-anonymized, secure collaboration, and all of this will catch on. And the carrier that does it first will take a significant march. But I think it's still a few years out before people sort of really decide that they have to bring in best of class rather than try and solve everything in house and allocate more to cloud.
And I want to maybe, pardon my ignorance, but in the initial days of the fintech and insurtech pre-COVID 2-3 years, you did see a lot of pure insurtech companies challenging the incumbents, or let's say digital insurers challenging the incumbents. And I'm not talking about the big tech backed ones or the big ones of the world who are very different and have a different scale. But in banking, you've seen the Revoluts of the world, the Starlets, locally, the virtual banks, and other places. I kind of feel in the last 4-5 years, I haven't heard too much of such the digital insurers growing so much. The market seems like the conversation is quietened down. I don't know if the growth has stalled, or, and as I said, and maybe I'm ignorant, but I would love to hear from you what you are seeing.
I mean, yes and no. I guess there have been some relative success in things like Lemonade. I actually don't know how Bota is doing here.
But actually, okay, they have a name building.
Acco from India, one of our portfolio companies, Air, is $1.5 billion in GWP in Europe. But I think they've not made as much of a dent in the industry as some of the new banks like say Wise or etc. have. I think there are two parts to this. One, it's not as the frequency is much lower, right? So the inertia to change your insurer is very, very, very The initiative to change your bank is not that hard. And I think it's easier to prove value in a bank.
Okay.
So say when Wise offers you a significantly better foreign exchange rate, you see it.
Correct.
You know, your $100 are getting to 1,000, whatever, 10,000 rupees rather than 9,000 rupees. It's immediate.
Immediate, yeah.
With insurance is not so immediate, right? You get a quote faster or something, but it's like neither here nor there. So I think it's been slower. But I think I think the other challenges which is getting, it's a licensed product. I think licensing will also be slow across the world.
Yeah.
But I don't think the story is written. I think it's just a longer story. It's probably not a pure play VC story. It's not like a 6 year, 5 year cycle. But I think some of these businesses that are already established, the Lemonades, the Hotels, the Aquas of the world, become significantly bigger over the next 10.
And do you also see the fintechs of the world like PhonePe and others were looking to enter at least the GI or general insurance perspective? You see that, right?
I think
when they're burning cash in the payment space.
my sense is that a lot of people had a lot of interest, and then they realized that insurance actually get the capital heavy business. Requires a significant upfront capital commitment. So they just waits people waiting. But I think the opportunity really exists, especially say things like life, which I'm seeing. Nikuta, of course, is here as a life insurer, but like India doesn't have any life insurance. The opportunity exists.
I've seen more innovative models like one big they did here, which is the pet insurance, right? Yeah. And they're growing massively in mainland because people in mainland are having a lot more pets, and we're also seeing this change in approach where you have double income of kids choosing optimal kids, and then pets become that alternative to some extent, and that's a market that is growing. Are we seeing more of that elsewhere as well?
Yeah,
other innovative.
Last year in Europe is doing really well. Japan and the US. So pet and making more pet digital has been a winner.
Right. Looking forward 5 years from now, the AI world is a completely. You don't know what will happen in the next week. I used to think it is a bit tough. Yeah, I used to be thinking, earlier fintech, I was like telling somebody it's so tough to catch up with all the things that happen in fintech. And once the AI thing came out, I feel even the AIs aren't able to catch up with what happens in the pace of growth. And it's more so, it's like massive impact. Plan, brace for it. So how would you, advise startups and others to deal with this going forward? How can they be mobile, agile, etc.?
Yeah, I think you have to ask yourself, are you in the direct path of the large language models? And the question there is it a generic enough sort of solution where you don't need specialized workflows, specialized data, specialized verticalization? If it's a pure play horizontal product, either it's not big enough, and hence the large language models are attached to it. In which case, why are you doing it? Is it worth your time and effort? Or it is big enough, and then at some point you're going to wake up like Figma woke up and have Claude having used the product. So the opportunity is in your verticalized data-centric place where there's a uniqueness of workflow, there's a moat around the data and the workflow, and then there is a industry move, right? So that I think it's hard for the hyperscalers to get into and solve the specificity. So be more specific and be more focused on your vertical and be paranoid about the data and the usage modes you're building so that you're actually building a defense. Say, Lord Wikipedia decided
it's a very interesting conversation to talk about the defense of the data and the moat. Satya Nadella in Davos, and I stand to be correct, but around that time, did an interview speaks about the enterprise intelligence leakage that is going into LLMs and others. You are using it, you may not have the right governance and safeguards, or your employees are just throwing in things into the free versions, and all of that is feeding into the models, and that strengthens. And I'm not saying Anthropic is doing this per se, but starts strengthening their own. And financial services has been a massive target audience or market for these LLM providers to hit, because immediate and financial impact or revenue.
The spend is also, no, I think shadow AI is just a big major security concern for both security and strategic concern for large companies. Bunch of startups have come around within our portfolio and rock offering solutions to help manage shadow AI.
Sure.
And yes, I think large enterprises are waking up to the fact that if you work only with these large language models, you are trading up your functions effectively.
Yeah.
And I think this is where the big debate is. It's going to be is the future going to be small language models, catering to specific localized? How are you going to make them more sovereign? Just playing out, across, right? And then you have challenges like Unifor that are taking this approach, and of course you have that OpenAI of the world which are building fully horizontal.
Yeah.
Then now you're talking about nationalizing the fully horizontal models.
Correct. Yeah, the deglobalization is fully in effect in the AI. That's going to be even more pronounced. Closing, your views on what are the exciting things coming up in the Asian market, Southeast Asia? Anything, fintech, insurtech, otherwise that you would be looking forward to? Let's say for the next year or two.
Yeah, I think consumer sort of facing apps on AI are interesting. Yeah. Look, I think South Asia, business spending is hard. So business to software stuff.
Yeah.
But opportunities around consumer AI from drama to things like finance management are intriguing. They're truly delivering value. And now with payment system, etc., you're able to do really micro payments and micro charges, which can aggregate to some really interesting numbers. So that's something we are.
Perfect. It's been a pleasure having you, Shwetank. Thank you for taking out the time and joining us here. And always great to have you in Hong Kong. I look forward to seeing you again, not here in Singapore or in India.
Likewise. Thanks for having me.
Thank you. Thank you. Thanks. Audience, stay tuned for more insightful conversation with industry leaders who are making an impact and know their stuff. Click like, follow, and subscribe for more such conversations.